The S&P 500 keeps pushing higher, headlines are getting more bullish again, and on the surface, it looks like the market is sending a very clear message: things are fine. But here's the real question. Is this rally actually broad and healthy, or is it being held up by a much narrower group of stocks than most people realize? Because if the market's gains are being driven by a handful of mega-cap names, especially AI-linked giants, then the headline number may be telling a cleaner story than the market underneath it actually deserves. So in this video, I want to break down why the S&P 500 rally looks strong, why some investors still think it's riskier than it appears, and what regular investors should actually watch next. Let's start with the obvious part. There are real reasons the S&P 500 has been strong. Corporate earnings have held up better than many expected. AI optimism is still a major force in the market. And Wall Street firms have recently raised their S&P 500 targets again, pointing to stronger earnings expectations and continued enthusiasm around AI spending. Reuters reported this week that Barclays and Stifel both lifted their year-end S&P 500 targets, with Barclays also raising its earnings forecast for the index. Reuters. So this isn't a case where the market is rising for absolutely no reason. There is a bullish case. If you're looking at the market from 30,000 feet, you can make a pretty straightforward argument. Earnings are still growing. AI spending is still massive. And investors are still willing to pay up for companies they think can dominate the next phase of growth. That's the bullish story. But that's not the whole story. The first reason some investors are skeptical is market concentration. When people say the S&P 500 is up, that sounds like the average company in the index must be doing great. But that's not always how a cap-weighted index works. The S&P 500 gives bigger companies bigger influence. So when the largest stocks go on a tear, they can pull the entire index higher, even if a big chunk of the rest of the market is doing far less. And right now, concentration is still a major issue. Depending on the measure you use, the Magnificent Seven, companies like Apple, Microsoft, Nvidia, Amazon, Meta, Alphabet, and Tesla, make up roughly a third of the S&P 500's value. Motley Fool recently estimated that the group represented about 34.8% of the index as of May 2026, while other market commentary has put the top-heavy exposure even higher depending on the basket being measured. The Motley Fool +1. That matters because it means the S&P 500 rally may not always be the same thing as a broad market rally. A rising index can sometimes hide a weaker internal picture. Fewer stocks participating. More dependence on a small cluster of leaders. And more vulnerability if those leaders stumble. So one of the most important questions isn't just is the S&P up? It's how many stocks are actually carrying it. The second piece of this story is AI. AI is not fake hype in the sense that it has no business impact. The spending is real. The revenue expectations are real. The market is clearly rewarding companies seen as the main infrastructure, cloud, semiconductor, and platform winners. But AI can also create a very specific kind of market risk: too much money chasing too few names. A lot of the current enthusiasm is centered on the same group of mega-cap companies. And when a rally becomes heavily tied to one theme, in this case AI capex, AI infrastructure, and AI-related earnings, you get less diversification under the surface. Charles Schwab noted recently that first quarter 2026 earnings have been strong overall, but the upside has still been disproportionately concentrated in technology and communication services, with the Magnificent Seven continuing to outgrow the other 493 companies by a wide margin. Schwab Brokerage. That doesn't mean the rally is fake. But it does mean the rally may be more dependent on one narrative than investors are comfortable admitting. And if that narrative weakens, maybe because AI spending cools, margins come under pressure, or investors start demanding clearer returns on all that capex, the market can suddenly feel a lot less stable than the index level suggests.